Welcome back to the Finanzfeuer Talk. Joining us today are MB Capital Strategies and Al Topo.
Hi everyone, Topo54.
Today's topic is dividends versus growth. The wrong debate. I've consciously decided against a pure growth strategy because growth forces me to hope for the right time to sell. Dividends, on the other hand, provide returns without the pressure to sell.
Yeah, you and your dividend strategy, I think that's completely wrong. It really should be, or rather, it's much more beneficial to focus on a growth strategy because the focus here is on price increases through expansion and innovation of the companies, which is just significantly more advantageous with prospects of higher returns.
I'm curious to hear that. This sounds like a real debate between growth and dividend stocks. Let's just take a look at the advantages of both sides. To me, dividends aren't a substitute for growth, but a different form of return. And especially with hard assets, cash flow is often more predictable and tangible than any growth narrative. Dividends don't always need growth. Especially with hard assets, I don't need growth to achieve high payouts. Pipelines, infrastructure, shipping, or energy are capital intensive, often already depreciated and operationally established. The business model is set and the cash flow is there. You have to distinguish clearly, of course. An established hard asset sector that already has its growth behind it can pay out well. A company that still needs to grow needs the capital within the company, so a high dividend is often counterproductive. That's not a judgment of quality, but a question of capital allocation. Very importantly, dividends aren't safe per se. Especially in cyclical sectors, they can be cut. But volatility isn't a problem if the cash flow is real, if you understand the cycle. With hard assets, it's completely normal for dividends to be cut for a year if major renewals or investments are due and then ramped up again afterwards. That's not a failure, but a part of the business model. Dividends lower the mental pressure enormously. I don't have to sell to realize a return, especially in drawdowns of 30 to 50%. That's a massive advantage. Cash flow equals staying power and growth is dependence on the market. Now I'd like to hand over to you, Aug Topo. What are the advantages here? Or rather, what would you like to add, if anything?
Well, so actually, those are very good arguments you're making here. There's not much I can say against them for now. So you're absolutely right, of course. Steadily increasing passive income is naturally a great motivator to keep investing. And that is definitely a really great thing to have there. And in particular, the low volatility of dividend stocks that has also been proven in the past to show that the company clearly demonstrates stability, which is also, of course, quite exciting. You are also completely right about the psychological advantage. You generate regular income without having to sell anything, which of course also helps you to achieve regular returns. Because through the regular and consistent distribution of dividends, you do not have to achieve your investment returns by buying and selling. This way, you avoid the risks associated with frequent trading. You know the saying, churning makes the pockets empty, because you can simply buy a dividend stock and let it run, collecting dividends over time, and then regularly enjoy the income from the distribution. And no market timing is necessary, which of course makes it much easier to achieve a return. And also, of course, the companies, they are disciplined. If they regularly pay out dividends, it also shows that they have a solid cash flow. And I completely agree with you that this proves that the companies have a certain long-term stability and have proven their profitability. Yes, but those are, of course, great advantages. But I also have to say there are, of course, disadvantages, and I would like to address those next. First of all, it is important to note that a strong and commonly cited argument against a dividend strategy is the relatively low growth potential of companies that shine through their dividends. Because companies pay out their profits as dividends, they have fewer opportunities to reinvest in their own business. Ultimately, what is paid out cannot be reinvested in the company itself, for example, in the form of new innovative products. And that's bad because it naturally prevents a company from further growth. Then, of course, you have to consider that taxes on distributions are also due. This means that every dividend you receive that is paid out becomes immediately taxable. You then simply pay the taxes. And if you then decide to reinvest that money in other stocks, what you are actually doing is investing with a smaller amount of money than you originally had. And if you choose to invest in other stocks that do not pay out dividends, you have the advantage that the profits made by those investments remain invested in the company and are not taxed at that point. This means your money can continue to grow inside the investment, compounding over time without being reduced by taxes until you eventually sell. And that gives you a much, much larger compound interest effect. And this compound interest advantage is lost or reduced through these dividend payouts. Then with the dividend strategy, there's also the risk of cuts, because in crises, dividends can be lowered or even cancelled. That's obvious, of course. When there's a crisis, then the company has to see how it handles the situation, and if necessary, savings must be made, or the company doesn't generate the revenue it did before the crisis. And that's ultimately reflected in the dividend yields. And you have to be extremely careful about the dividend trap, which can occur if you focus heavily on a dividend strategy, because high yields, that can indicate problems as well, of course. Here's a very simple example. If we look at a situation where a stock, for example, a dividend stock, cost 100 euros in share price, and it pays out, for example, in February, 5 euros. If a crisis hits, like the Corona crisis, and the stock suddenly drops 50% because it's heavily affected, then you could see from the statistics, oh, suddenly the share price is 50 euros, but the stock paid out 5 euros in dividends that year. Then you might mistakenly see in the statistics that the dividend yield has suddenly risen to 10%. That means you have to be careful with these exact numbers when using a dividend strategy, so that through such dividend traps, which can occur in these statistical values, you don't get lured into the wrong dividend stocks. Well, I've played devil's advocate a bit here. Do you agree with me? Maybe on those individual points, or do you have a different perspective on it?
Exactly, especially with the dividend trap, that can definitely happen. That means you definitely have to know what you're investing in, so you have to know the company itself. You should also know what their payout policy is like. You can usually read about that in the quarterly reports above all. Personally, I prefer, well, stocks that simply have a very open, shareholder-friendly dividend policy, meaning they might even announce their dividend 3 months in advance, so you know the current situation. Generally, I'd prefer stocks, as you said, money is needed for growth, that have established business models and don't know what to do with their cash. For example, pipelines cost a lot of money until they're built. But once they're built and the oil flows through, or the water, or whatever, or hydrogen, they get so much monthly cash flow that they'd rather pay it out to shareholders as a return, because they just don't know what else to do with it. And if they can't build any more pipelines, for example, as we're discussing here, they just prefer to pay it out. And we're seeing that right now in the oil sector. That means you just have to know the sector you're investing in, their dividend policy, but otherwise, those are all real valid counter arguments that are naturally against a dividend strategy. You've already reported on that very well and in great detail, yes.
Well, then I'd say let's take a look. If we have so many counter arguments for the dividend strategy, what are the concrete advantages of the growth strategy, which I personally like very much? Yes, so with the growth strategy, it's like this, you have a significantly higher return potential. Because successful growth companies can really gain a lot, that's naturally very, very appealing. Because in the growth strategy, disproportionate returns are quickly possible, which in the dividend strategy would rather remain a dream, in my view. You invest more in innovative companies that still have huge growth potential ahead of them. Mostly you see that, especially right now in technology companies, which are very exciting. Then the topic of taxes, we also discussed that briefly already. The growth strategy has the advantage that you're more tax efficient here. Taxes are only due upon sale, except for the advance tax, which is naturally due every year on such a small part of the profits is due. But still, the largest part of the profits you make, they only become due upon sale. That means instead of paying taxes immediately, you can leave the untaxed profits invested to ultimately ignite a return turbo. This gives you a significantly higher compound interest effect, which you then well, which gets lost a bit with the dividend strategy. Then you have another advantage that the growth strategy is very future oriented. The focus here is on innovation, market share, and scaling the companies you invest in. Mostly we're talking about small. So mostly we're not talking about these typical old-fashioned real estate firms, companies, or similar, but really about innovative companies, often in tech, as I just briefly mentioned in the first point, with massive growth opportunities. And that is comparable, cool as private equity ultimately. And naturally, the strong compound interest effect, I'd like to emphasize that again here, so to speak, reinvested profits, they naturally also accelerate growth. Not just the gains you hold in the stocks, but also the company itself, which doesn't pay out its profits through dividends, but keeps them instead. The company can then, of course, reuse and reinvest those funds back into the business itself. So companies basically use profits to further develop their products and to open up new markets with their products in order to expand. That is, of course, very, very beneficial for the companies. And what's beneficial for the companies is naturally also good for the stock price in the end. Ultimately, these are reinvestment opportunities that the company can use to become larger and to grow. So those would be the advantages I see with the growth strategy. Now, the question for you, do you have anything else to add here, or do you want to start hitting back with the disadvantages?
I'd like to add something briefly, perhaps, because I didn't mention it quite explicitly earlier. You're kind of, shall we say, harping on about the compound interest. However, you naturally have that with the dividend strategy too, because first, you reinvest the dividend you've been paid out. Or you could say the company should just invest it directly, or rather, the broker, so direct reinvestment. In theory, you have that too, of course, minus taxes and potentially withholding tax as well. But nevertheless, dividends are often even increased. Especially in the hard asset sector, they're often adjusted for inflation. That means you often have dividend growth of about, they say, about 7% a year in growth alone. That gives you an indirect double compounding effect, even if the dividends are increased. But now I'll start right away with the disadvantages of a growth strategy. I just personally wanted to add that very briefly.
Oh, now I'm curious.
My point of criticism isn't growth itself, but growth at any price. When growth is expensive, meaning highly valued and driven solely by price speculation, the risk increases exponentially. Then I need perfect timing, and very few people have that to actually realize a profit. Just to add briefly, these are more the issues for individual stocks, of course. With growth ETFs, I see things a bit differently. It's more tailored to the topic of individual stocks now.
Yes, well, as much as it pains me, I naturally agree with your counter arguments. I mean, sure, you're absolutely right. You just have higher fluctuations there. With the growth strategy, prices react sensitively to news. You see that every day when you look at the stock prices of any company, especially with growth-oriented companies. The price increase from last week can, of course, completely disappear again instantly due to a crash, be it a mini crash or smaller, well, basically smaller downward fluctuations. You don't have any ongoing income, of course. Income is only possible by selling off shares, and that is, of course, also a difficult thing. That's where the issue of timing risk comes into play. When do you actually sell? When do you buy again? When do you get in? When do you get out? A bad selling point can, in this case with the growth strategy, reduce returns, which can be very unfavorable. And as you say, market timing is difficult to impossible. Very few succeed, and even experts usually don't get it quite right. And above all, it's exhausting and takes a lot of time for intensive research, which many people don't have available or can't afford to spend. Yeah, and so I definitely agree with your arguments as well. Now, we've looked at both sides now, the dividend strategy and the growth strategy. We've had and discussed pros and cons for both sides. In summary, we could say the dividend strategy is advantageous or just really cool because it brings stability and regular income in the form of cash flow. The growth strategy is especially cool because of the higher opportunities, but of course, it also has the higher risks that come with it. And I think we're both quite sure or in agreement that many investors often prefer a combination of both strategies, for example, through broadly diversified ETFs and a mixed portfolio. Then you have both the advantages and the disadvantages, both covered within a single portfolio. So I'd like to ask you again, what's your personal conclusion or experience, or rather, how do you actually do it in practice?
Exactly. So finally, I'd like to say something briefly. Well, it's also the case that everyone has their own strategy, and it's definitely right for that person, and they can follow through with it accordingly. The important thing is that the strategy suits you. As for me, or from my experience, I deliberately focus on dividends from hard assets because I want cash flow, regardless of whether the market is euphoric or nervous. For me, dividends aren't a sacrifice of returns, but another very real form of return, which is worth noting. Cash flow doesn't need growth, it needs a functioning business model, like in the pipeline sector, for example. What's your conclusion, Octopo?
Yeah, well, for me, it's like this. I personally aim for or target the following portfolio structure. So I put 2/3 into a growth portfolio. My current target value is the first 100,000 because they say that from 100,000 on, if you invest in growth, you get a huge snowball effect that slowly starts to happen. And I find that very attractive too, and that's definitely what I'm aiming for. And a third of my portfolio is actually in dividend stocks, simply because those regular payouts you get provide me with some financial support. You also get a sense of success when you see that you're getting more and more monthly payouts year after year. That also motivates me to keep on saving. It gives you a higher monthly income, and my goal is to, well, eventually have a dividend portfolio built up that gives me an extra 500 euros available every month.
Exactly, that's great, yeah. So you see, everyone has their own approach. In the end, it definitely has to be customized. I thought it was a very detailed exchange in general. Everyone was able to share their strategy a bit and also explain what's important to both of us, which we'd like to pass on.
I have nothing to add to that.
Then, very importantly, the disclaimer, of course, this isn't investment advice, just our personal strategy. If you liked the video, please leave a like and feel free to subscribe to both of us. And yeah, we definitely look forward to every interaction with you, so feel free to comment. We'll definitely be happy to comment back. I'd say that's it for now with this series. Then I'll say see you in the next video. Until then.
Until the next finance talk. See you soon. Bye bye.